So guys, welcome to VRD Nation. We are in the middle of a roaring bull market where the markets are making all-time highs almost on a daily basis, right? And it is such a remarkable thing because just a year back, the market was somewhere around 7,500 on Nifty, and today we are above 17,000. So this market has made this tremendous move in a very short amount of time, and this has caused a lot of people to pause and think that how far this market can go and what should they do at this point of time. So I thought, why don't we make a video about this? And even though the question is the same, that how far this market can go, the answer to this question will depend on the person who is asking this question. So what do I mean by that? Well, there are four type of people who are asking this question, and let's just try to put them in different categories. The first two will belong to the category of long-term investors, and the second two will belong to the category of short-term traders, right? So let's start with this first group of investors, the lucky investors who have been in this market for a very long period of time. They are sitting on significant gains, and if you are one of them, congratulations for being such a good investor, and I'm sure the market is rewarding you for that. Now, if you are wondering what should you do now, then the right way to think about it is forget about the market, right? Forget about what the market is doing right now. Focus on your goals. How far are your goals from this point of time, right? So let's say, for example, you have a son or your daughter who is, let's say, in the 10th grade, and you have been investing in this market for a very long time to prepare for the college fund, right? The college education. Now, given that the amount of time left for your kid to go to college is very short, this will be the time for you to take the money out of the market, maybe partially, so that you can eliminate the market risk, right? So you need to think more in terms of goals rather than what the market would do next, because the reality is that there is a certain date on which you need to pay the fees to the college, right? There is an application deadline and there is a date on which you have to make the fees. Now, at that point of time, you don't know and I don't know what the market would do. And you cannot tell the college just, hey, the market is down right now, just give me maybe 2 more years and I will pay you the amount. That's not how things work in life. So you need to eliminate the market risk by systematically taking the money off of the equity market and putting them into relatively safer funds or relatively safer assets such as fixed deposits or debt fund, whatever is the case, where you don't have the market risk, right? So that's how you need to think from a goal perspective. So that is for the people who have goals that are coming in the next couple of years. But let's say your goals are very long term, right? Like 20 years down the line or 30 years down the line, you are basically planning for, let's say, your retirement. And if you are planning for that, then you don't need to worry, right? I mean, end of the day, when you are investing, you have already been investing for a long period of time and you have your goals which are very far away. Your focus right now should be to ride as many bull markets as possible, right? So in my experience, the more bull markets that you expose your portfolio to, the higher returns that you can get. And because the time is on your side, you have a lot of time for your next goal. You can sit on your investments for a long period of time without having to worry about what the market will do next in the next, let's say, the next 6 months or 1 year or 2 years. Now let me talk about the second category of people, which I'm sure a lot of you belong to. That is those people who have entered into the market relatively recently, or maybe you entered a couple of years ago, but you have not invested enough in the market and now you're wondering what to do next, right? So this category can further be divided into two types: passive investors and active investors, right? So let's say you are a passive investor who is investing, let's say, in mutual funds, doing SIP, or you're investing in some ETF and just like on a monthly basis, you're contributing something. So if you're a passive investor and your goals are again 10 years down the line or 15 years down the line, it won't really matter where the market is at this point of time, right? Now, this is kind of counterintuitive because, we think about, okay, buy low and sell high, and the markets are, of course, in at all-time high right now. But for a passive investor, high and low is a relative term, right? So think about it right now. Let's say 20 years down the line, the market is at 50,000, Nifty is, let's say, at 50,000. Will it matter whether you invested at 17,000 or 15,000, right? Not so much. So for a long-term passive investor who is, investing on a monthly basis, I don't think there is any consideration that you need to make. You just have to be disciplined. You just need to be consistent and no need to worry about whether the markets are at high or low. You just keep investing and investing and investing, and let the market take care of the rest, right? So that's like for the passive investors who have a long horizon. But if you're an active investor, right, you want to pick your own stocks, you want to be more selective, you want to let's say you have a shorter horizon and you want to enter into the market when the markets are low. Now in that case, of course, this is not the market where you should be entering, because the market is very overheated right now. So what you need is a correction in this market before even you can step in, right? So correction by the traditional definition of the stock market is 10% from the top. So ideally for traders, I would say that 10% correction is a great correction for them to enter. But for investors, I would say you need to wait for at least 15% and ideally 20% from the top. And at 20% from the top, it is technically classified as a bear market, right? Now, the funny thing about market is that when we are in a bull market, it almost feels impossible that the market will ever come down, right? So we always have this feeling of missing out, that everybody else is making money, I'm not making money, and that I'm sure is happening to a lot of people. But the reality is that the market doesn't always keep going up, just as the market doesn't always keep falling down, right? So in the bull market, we get the feeling that this market will never come down. That's what people thought back in 2016, 2017, it will never come down. They had the fear of missing out. But what we saw in 2018, 2019, and of course 2020, that the market always gives an opportunity for us to invest. So if you're an active investor and you are looking to buy into the market when the markets are cheaper, you need to have patience, right? You cannot just run after the market and kind of chase the market, because the next thing you know, because your horizon is shorter, you don't want to be buying high and later forced to sell at a lower price. So patience is the key for this category of investors. Now let's talk about these two categories of people who belong to short-term trading. And within that, there are two camps. One believe that the market will keep going higher and they have long positions. And then the other camp, which is actually very, very active right now, that believes that the market is going to go down and they have created short positions, right? So let me start first of all with the people who have taken long positions. What should they do and what should they expect? First of all, if you have long positions, you are making money, right? So of course, be happy about it and be glad about it. But the one thing that you need to understand is that this market currently is in a parabolic stage, right? The acceleration with which the market is moving, that is indicating that we're in a parabolic phase. And the characteristic of a parabolic phase, and if you have history as an indication, and you can see recently, let's say Bitcoin, when a parabolic phase comes, that signals that the market is getting a little overheated, and you should ride the wave as far as you can, and you should stay in the position as long as you can. But at the same time, you also need to have some realistic expectation that at some day this party will be over, and you need to be ready for that. Okay, so don't be surprised if one fine day the market comes down, let's say 2%, 3%. You should not all of you feel shocked that, okay, what has happened, right? So this is very normal for a market which has gone up significantly. For it to correct a little bit, it's very, very normal. So let's say you are a conservative trader and you are sitting on some profits. You can do some partial profit booking if you feel like, or you can trail your stop loss if you want to. But my advice will be ride the wave as far as you can, because when the market gives you an opportunity and when you are in this parabolic phase, you don't know how far the market can go, right? So it's better to ride the wave and book some partial profits in case you feel a little bit vulnerable. You can do that as well. Now let me talk about the most interesting category of all four of them. These are the short-term traders who have taken short positions in the market, maybe on Nifty or Bank Nifty or Reliance, and they are of course incurring losses and they are wondering what to do next, right? So if you are someone who have taken one of these short positions and you are wondering what to do next, you have to pay attention to me very, very carefully. See, what happens is when people take short positions, because they believe that market has gone up this much, how far can it go? And that is generally the temptation for taking short positions. And then once we have taken the position, we try to justify that by finding evidence that supports our view, right? So this is called selective perception. So you have already made up your mind. Now you are looking for evidence to support your view. So people come to me all the time. They will cite some technical indicator that RSI is above 80 or about 90. This is in a very, very overheated territory. It's going to come down. Or some of the people, they will cite put call ratio, that put call ratio, look at it. It's about 1.6, 1.7. It's getting like way too high based on the historical standards. And interestingly, some of the traders even start thinking as an investor, right? All of a sudden they become investors And now they are telling us, look at the PE ratio of the market, right? I mean, before taking the trade, they had no idea about the PE ratio, but now all of a sudden they're all investors. And they are talking about, the PE ratio of the market is at 25, which is very, very overvalued. The market is due for a correction. So what is happening, and again, I'm not trying to criticize, I'm just trying to make a very important point, is that we take a trade first and then we try to justify it later. And that, in my opinion, is really a bad idea, right? I myself am guilty of doing this, and I'm not superior to anybody else. I myself have done it and I have burnt my fingers. So when I'm giving this advice, it is basically coming from a place of goodwill. Right? So take that in that spirit. So my advice is going to be very important. So please listen to it very carefully. Yes, the market is overvalued. Yes, right. So put call ratio is very high. Agreed. RSI is indicating, the market is overvalued. Perfectly fine. I all agreed. But the market can remain overbought longer than you can remain solvent. I will repeat it. The market can remain overbought longer than you can remain solvent. What it means is that, yes, the market will come down at some point of time. Nobody knows when it's going to come down, but at some point of time, it will come down, right? And your view will materialize. But the problem is, time is not on your side. You are a trader. You're not an investor. You are a trader. You have taken positions that have expiry, let's say in the next few weeks, maybe in a month or maybe a couple of months. So your view not only has to materialize, it has to materialize within that short span of time. And that is the biggest risk, because the market can keep going higher and higher and higher. Take your stop loss. And from there, if it starts to turn and eventually, let's say it came down, but you still will be incurring losses. So the reality is that people, from a long-term perspective, anybody who ever made serious money from the stock market as a trader only made money by following the market, not going against it, right? There are, of course, some exceptions once in a while, but the majority of the traders who made money, they made it because they respected the market, they listened to the market, and instead of fighting with the market, they went along with it. So my humble suggestion, my 2 cents is that if you cannot go along with the market, at least don't stand against it, right? So respect your risk, respect your capital, and above all else, respect the market, because this market can be very brutal. If you go against it, you never know how far the market can take it. And if you lose more than an X amount of your capital, it's very, very hard for you to come back. So keep that advice in mind, because this is going to save you from incurring some serious losses. So guys, these are the 4 categories of people who ask how far the market can go, and I believe that I have given some reasonable guidance on what each of these categories should do. But notice that I have not talked about at the exact level, right? I have not talked about the market can go to 18,000 or 19,000 or 20,000, but why, right? And I know a lot of people, they get frustrated when I not talk about the levels, because it seems like you're kind of avoiding the question. But now I'm going to tell you a secret, right? Are you ready? I'm going to tell you a secret. The secret is, nobody knows the top of the market and nobody knows the bottom of the market. This is true. This is true. No matter what people are saying there on social media or on TV or your friends or colleagues, nobody, absolutely nobody knows the top of the market and absolutely nobody knows the bottom of the market, right? So I know people are trying to tell you, and what they are trying to do essentially is they are trying to sell certainty in the world of uncertainty, right? When we feel uncertain, we are looking for a guidance, and the reason you are watching this video is basically there is an uncertainty that you are trying to avoid. You're looking for some guidance, somebody who is experienced, who can tell you, this is what the market will do, so that you can plan based on that. Whereas the reality is that nobody really knows, right? So people who are saying the market will go to 18,000 or 19,000, they have no idea. I mean, they have absolutely no idea, and they don't have any skin in the game either, right? They are not investors, they are not traders, they are basically, this is their occupation to just give these predictions, sometimes which can come true, sometimes which might not come true, but they get paid for doing this prediction because people like to hear people talking with confidence about, 18,000 is the next level or 19,000 is the next level. But the reality is that nobody knows. So again, my advice is that forget about the levels, right? Forget about the levels. Identify in which of these categories you belong to, and rather than focusing on what market would do, Focus on your own circle of control. Like what is that you can control? If you have short-term goals, start planning, to come out of the equity market, de-risk yourself. If you have long-term goals, you have nothing to worry about, just keep investing, right? If you are someone who has long trade, just stay and ride the wave. If you're a short trade, manage your risk. So this is what you need to do, because this is what is in your control, right? Whatever the market does, the market does. You just need to react based on that. So I hope, apart from like not giving any levels and staying away from all that, but whatever else that I have said, at least will give you some insights into what you can do and how you should look at the market. And I hope at least it will help you in making some informed decisions.